So when it comes to asset protection planning, the annual reset has been a game changer in the market volatility area of comprehensive and effective asset protection planning. It has almost single-handedly revolutionized the market volatility aspect of asset protection planning, and it's been huge when building more lifelong income with less of your money in retirement. Didn't know you could be your own creditor, did you? So if you use an inefficient retirement income plan, you're unnecessarily wasting your assets, right? Doesn't that make you your own creditor if you're doing that? Yeah. Hey, my name's Kurt Jackson, Asset Protection Planner with KJ Financial. So what's the annual reset, right? Well, it's a feature that's found in fixed indexed annuities and index universal life policies. So in those types of policies, they're structured to link to an index like the S&P 500. But they're not in the market, they're just linked, right? So since they're not actually in the market, they can protect against losses when the market drops. And the way they've got a unique feature the way they handle this, but they are able to credit gains when the market or the index is up. All right, I know. You want to know this, right? How much do they credit? So depending on several factors, the amount credited in up years can come in the form of crediting up to a cap or crediting a percentage of the gain that year. That's called a participation rate. Or a spread option, okay, not a football play, but a spread option, where they automatically deduct a specified percent from the gain in up years only. Right? There are a few other crediting strategies, but we're not going to delve into them here. So in some indices, participation rates can be as much as 100% or higher. Therefore, you're getting all the gains or more in those indices. So next up, the annual reset locks in all your principal, contributions, and any gains on an annual basis or 2, 3, or 5 year basis, depending on the product, and protects all that money from loss. So hypothetically speaking, assume you had a 100,000 balance in a fixed index annuity with a 40% participation rate, and the S&P was up 15. It's linked to the S&P 500, and it was up 15% that year. Your account would be credited with 40% of that 15% gain, or 6%, thus making your new balance $106,000. Now, all of that $106,000 is now locked in and protected from losses due to the market going forward. All right, so why is this key? Well, losses are powerful on a couple of different planes. For one, losses have been found to be emotionally more damaging to individual investors than the good feelings big gains give us. Losses are also devastating to our ability to build wealth. So if we asked how much of a gain you would need to get back to even if you lost 20%, most folks would say a 20% gain, mainly because nobody's really ever explained this to them. But if you had $100,000 and lost 20%, you'd lose 20 grand, right? And have a, $80,000 balance, right? So if that 80,000 then had a 20% gain the next year, how much is 20% of 80,000? 16,000, right? So 80,000 plus 16,000 is only $96,000. So you're not back to your $100,000. You're not back to even. So if you take the loss, 20 grand, and divide it by the new balance, 80, it shows you that you're going to need a 25% return to get back to even. But wait, because it gets worse. The bigger the loss, the bigger the return needed to get back to even grows exponentially. So a 20% loss needs 25% to get back to even. A 50% loss requires a 100% gain to get back to even. Now, from the peak in 2007 to the floor in 2009, the S&P 500 lost about 59%. It takes a 143.9% return just to get back to even. How many years will it take to get back to even? Could be several, right? But wait, there's something else. Aren't I just filled with great news today? So what do you pay every year in your investments, whether you're up or down? Fees, right? So all our research shows actively managed money averages, most 401k plans charge about an average of 2.2% per year in total fees. Okay? They may say they don't, but that's what they actually do. Do you think fees can do some horrible damage? Well, first, they reduce our gains, right? Second, they amplify our losses. And third, they slow down our ability to get back to even. Man, that's terrible, aren't they? So here's a graphic showing a $10,000 investment over a 40-year time horizon, earning a 7% average annual return. Would have netted you $149,745 if there were no fees on it. If we assume you had just a 2% fee, your balance after 40 years is now $70,400. That's $79,345 in lost wealth, a whopping 52.99% less. Has anyone ever shown you how devastating fees can be? Let me ask you again, do you think fees can do some horrible damage? Should it be something that we focus on? A comprehensive and effective asset protection plan attends to the details, which also includes minimizing fees or eliminating when we can. If a small 2% loss in the fee can do that much damage, imagine what bigger losses can do. Now keep this in mind. Since 1900, the stock market has averaged about a 47% loss every 11 years. And since World War II, it's averaged about a 33% loss every 6 years, right? Isn't that about 66% every 12 years? Dang it, that hurts. So using our on-point risk analyzing tool, we've done a comparison from September 1st, 2003 through April 1st, 2020, the max that we can do with this comparison. Okay? We have a fixed index annuity with a 4.5% cap and an index universal life policy with a 10.25% annual cap, and the traditional risk mitigation plan with a 60-40 stocks bonds mix. So while we almost always look at the return, the compounded annual growth rate, now that's actual return, okay? And see that the 60-40 mix beat both our safe money strategy over that time frame. But there's some caveats to that, all right? And what we're trying to show you here is the power of not losing money. Notice the blue column in the middle where the 60-40 mix lost 32.2% at some point. So look below at the chart. So on the left side, that's the performance chart. Notice the blue line and the green line. They have stair-step growth, no losses, right? That's the annual reset working. All right, so now focus on the blue line, the index universal life insurance versus the 60-40 mix. That's the black line. Right? See how much most of the time it's at or above the black line? So wouldn't that mean that you'd have more opportunities to retire comfortably along that line, not worried about losses, right? Because do we know what the market's going to do? I don't. Do you? Does anyone? No. So aren't there several times that the blue line would have given you the confidence to retire while the black line would have created concerns? Yeah, that's what asset protection does. It lets you be more flexible or more flexible when you want to retire. Now, don't forget the one huge benefit the index universal life policy has over the 60-40 mix. The growth in it and the income coming out of it is all tax-free. So when you're comparing returns, is it an apples to oranges comparison until you adjust the 60-40 mix to return an equal, to make the return to an equal tax-free return? So if you were in a 25% tax bracket, the 60-40 mix would need to be 8.99%, much higher. Hey, let me make a point of clarification. A majority of the fixed index annuities with the annual reset, they don't have fees unless you select one of the riders, while the index universal life policy does have fees. But over time, the 20-year plus horizon or more, the fees average much less than the average fees that you're going to see in 401ks and active managed money. Okay? So hopefully you're starting to see the power of avoiding losses and using the annual reset to make sure that you always have all of your money working for you when the market index is moving up. Hey, we encourage you to check out other videos on our YouTube channel, Asset Protection Nation. Great information we share there. Or if you're ready to dive in and get deeper on this and get more information, you can click on the link that hopefully is popping up now on the screen and get more in-depth info from our Asset Protection Nation Masterclass on-demand webinar. That's such a mouthful. Basically, it means you can watch a recorded version of our webinar anytime you like. Encourage you to take advantage of that. If after you've watched that, you want to set up a time to meet with us, you'll have that option to do that there below where the webinar is. All right, so if you have questions that we didn't answer or new ones that maybe our info may have created, please enter them in the comment section below. We try to address these as quickly as we can, and when we get really great questions, we may even do a video about it. Also, if you found value in our video, please share it on your social media. And always, there's going to be something should be popping up here, a link to subscribe to our channel, okay? The Asset Protection Nation channel. Make sure you subscribe to that so you get all our future content right when it comes out. Hey, I want to thank you for stopping by. Certainly hope we get to meet someday.